Hi, everyone. I'm Rick Bensignor. Today is Tuesday, July 28th, and welcome to this week's In the Know Trader show. This week, we will do our trader education portion on Bollinger Bands and volatility, and I'll show you how I look at them somewhat differently than other people do on the street. We'll do our markets overview as we do each week, and then this week, we're going to revisit the group that we looked at just about a month ago, which are gold and silver names. And I wanted to go back to them simply because they are up so sharply in the past month that I want to update for you key levels for, I don't know, a dozen or so names here. So we'll go through those one by one as the show goes on. So let's just take care of a couple of house cleaning things. In order to contact me, it's rick@inthenowtrader.com. And of course, our website, inthenowtrader.com, is your way to get more information and sign up for our newsletters. Again, we do and use institutional models that you do not have access to and that major institutions across the globe use in order to help time, buy, and sell decisions that they have. So each week we review a bunch of major markets, including the S&P, usually gold, oil, the dollar, etc., to give you a good global view of what's going on before we dig more deeply into things. And then, of course, a new ETF trading idea each week. That's for the Tactical Trader Report. A reminder that we have a new piece coming out August 1st called 711. It is a macro sector ETF report that will aim to get you in no more than 7 of the 11 SPDR ETFs at any one time, with the goal of beating the S&P over time by avoiding the underperformers. And we'll actually do a special show on that later this week or early next week on StockCharts. So stay tuned for information on that. Okay, let's go to, I want to show you what I do with Bollinger Bands. So here's the IEF ETF. This is the 7 to 10 year, similar to like the TNX, but of course TNX is the actual yield. This is the tradable bond ETF. And I've thrown out, it's a weekly, actually it's a daily chart, and I've put Bollinger Bands on here. And what I want to show you is the way I kind of use these. Now, when you're in a range, obviously Bollinger Bands are meant to include about 90% or so of all tradable action. And I use the standard formula of a 20-day simple moving average with 2 standard deviations above and beneath. Bloomberg, I know, has years ago went to 30 days. I don't know why they did that. It is not John Bollinger's default settings. And I like to use 20 and kind of stick with it the way it was written. So you know that in sideways markets, we often will trade from the top band to the bottom band. And you know markets are somewhat sideways, not only by looking at the price action, but also looking at Bollinger Bands flatten out. When they flatten out, you tend to be more in a trading range type environment. And obviously, when they take on sharp angles, it's because the underlying security has also. So one of the things that I find useful, besides using them in the traditional way, is also as a judgment of volatility. And when you see the bands go flat, it is a true signal that volatility has come in. And when they widen out, I don't mean when they change slope, because here on this section, let's say in between December and February, so late 2018 into early 2019, the bonds moved up, but the difference between the upper and lower bands kind of were the same. So this is that there's really a minimal, if any, increase in volatility on this up move. Um, Clearly, if we look at what happened in March, the differential between the upper band and the lower band widened out significantly, and that's really where you have increased volatility. And for those of you who understand how to use volatility to your advantage through options markets, uh, it's a very useful tool in understanding when you want to be buying options versus selling options. So one of the things that I can do too, that my software allows me to do, is to actually display the difference between the upper and lower bands in points, in actual dollar differential between where an upper band and lower band is at any one time. And what it gives you a clue is it kind of gives you a base level. When I look here, so the bottom here came in just about 0.65 points, so pretty small. Here, on this move here, we get to about 1 point in between. Here we get to 1 point. Here we get to just over 1 point. On the bottom here, it's about 1.2 points and so on. So I kind of get a sense that here in this, for this particular ETF, somewhere around 1 point differential is about as low as it goes. And then I can see, obviously, it widened out to over 10 points on the huge decline in March in stocks, and of course, bonds went straight up as a flight to safety. So I kind of know where and around where this tends to bottom. So I know about as close as they're going to get to each other just by looking historically at this chart. So it gives me a sense of knowing too that when they get this narrow as they are now, the likelihood is they're not going to materially go down, but at some point this is going to move higher. And what I often do is look for a breakout of the bands to tell me which direction it's likely to go after being sideways. So here, if we take a look at a month-long sideways area, in fact, two months of price action sideways, a month long here right in the middle of the chart of the Bollinger Bands going sideways, then we close outside the band, and that's often the clue of which way you're going to get a breakout from a consolidation. So even though volatility is increasing, this gives you the clue that you're likely going to make your move to the upside. And that's a way of getting long the market, is by playing for closes. You could use one or two, it's up to you, of going from sideways to seeing expanding vol that also breaks out above the top end or beneath the bottom end of the Bollinger Bands. Let's take a look at something like GLD. All right, so a lot of people have been long gold. Here you have also a market sideways for a few months. This is back in 2019. They narrow even more. You see that we made a lower low of the difference. And for those of you who don't have access to software that'll show you the difference, you could, in theory, create an Excel spreadsheet that very simply looks at the value of the high band and the low band and gives you the differential. Here, after sideways, breakout to the upside, right? This broke above the upper band. That gives you the whole new move to the upside. On the downside here, notice this. Now, this was March this year, so you can't trust it as much because of what's going on. You broke to the downside, but you can see already that this move to the downside was already on expanded vol, and it wasn't a sideways pattern. So you generally want to look for sideways narrowed Bollinger Bands that then break out in either direction, and that often gives you the clue of which way the next move is going to be. So that's one of my favorite things to do, is to watch for sideways and then look for a breach. In this case, it didn't work. So it's not always going to work, but I find more often than not, more often than not, so it's not close to 50-50, it's much better than 50-50, that this will work in your favor over time. And you can do this in any time frame. And of course, if you understand the implication of volatility, so let's say you get a buy signal here, sideways for a month, they're very narrow. You can see they came about as low as they ever go, and then we break out to the upside, so it tells you want to get long. Another thing I can do, which again, my software lets me do, is let's say I can add a study on this. And now if I put up DeMarc's sequential and I add it to the actual differential to the Bollinger Bands, they've gone very narrow in here. They're sideways. And look, I get a downside exhaustion sequential 13 saying downside exhaustion to the difference between the Bollinger Bands, indicating that they are likely going to expand. They do expand, and they expand to the upside, and that's a clue too. So I can help time these moves. Looking back here, telling me downside exhaustion. We're sitting sideways. We get a breakout a couple weeks later. That's a better chance that that's a true breakout. So I now run models on the differential between the Bollinger Bands to help better time. There's a 13 downside exhaustion in here. Look, there's a 13 upside exhaustion here at the highest level that we've seen this thing trade in years. And that corresponds to this move right in here. So it suggests that they're going to narrow. They actually widen out a little more, but the stock itself comes way off. So again, helpful tools in understanding how to use Bollinger Bands. And in the No Trader clients, these are some of the things I use when I write about markets. And that's part of the reason why in the No Trader gives you what institutions are looking at as compared to other types of standard textbook ways of looking at markets. Okay, let's go back to our PowerPoint presentation and take a look at our week over week macro sector movements. So on the right hand side, this is through yesterday's close. On the left hand side, this was through last Tuesday's close, year to date. And what we see is that well, I've got this floating green dot. I don't think it's current from this week. So we have two underperforming sectors, and 1, 2, 3, 4, 5, 6 of the 11 moved up by more than 1% last week. So just look in this week, and sometimes these don't line up when I clip them, but we actually have the zero lines at the same place. So this past week, you can see that commercial services came in more than 1%. Tech, which had been leading all year, it's still leading, but now it's only outperforming by 17%. It was almost 20% last week. So tech's come in, still the best sector there is, but not nearly as much so as it has been recently. If I remember correctly, it might have been even as much as 30% better than the S&P not that long ago. A better sector last week is industrials climbed, materials climbed, energy climbed. So the worst performing group picked up almost 3% or so week over week versus the S&P. You can see a negative level here in staples that's now gone positive. So that's picked up more than 1%. And even financials, which were down 22% last week, now they're only down about 21%. So that picked up a little over the past week, as did real estate. So again, I like to look at what's moving sector-wise, see what's trending here. Certainly, I've noted that technology, although still the best performer, is well off how much outperformance it's seen. So that has come in. And if you just were to look at this, you say, oh, well, yeah, technology is certainly the outperformer of the year. And factually, it absolutely is. But in the last month, it has come in dramatically. So although it's still the best sector, it's lost a lot. So if you went into, let's say, XLK just a month ago, you actually have not done nearly as well as if you had been in the S&P as a whole. So that's that. Now, let's get to our weekly kind of market update. So we go back to our charts, and let's, okay, so now let's get to, let's start with the S&P on a daily chart. All right, so here we go. So you know that we had this lighten up, this whole pink zone from 3,000 to 3,175 is where I had recommended reducing overall long exposure in the market. And obviously we've pushed through there. At this point, you'll see last week went exactly to the high of this move, is right to the stop out point from this 13. So we're still in it. We get, if we get above 32.90, 10 points above the current high, I would probably say that that would make me know for sure that what I had done here, lightening up. In other words, reducing exposure was not, did not work out. And you certainly have the option to put it back on, and all you lost was opportunity cost. We never shorted the market. We just simply said, this is a good area to reduce long exposure. And we had said that all the way back from April. So when the market was way down here, we still said between 3,000 and 31.75 was the place to do that. The major buy zone is, underneath 2,700. In the no trader clients know where we've created a new higher level aggressive buy zone, which at this point makes me, and seeing what the market's done, makes me feel as if we're not likely going to get down here later this year. And therefore we've upped it, and the no trader clients know where those levels are. Let's take a look at gold. Obviously, gold is on all-time highs. You can see this horizontal red line. That was the prior all-time high back in 2011. We have now exceeded that. In fact, it happened in the last day or two, but also realize that it comes with a monthly TD combo that's a sister model to sequential upside exhaustion signal. Now, I look back to the last two times that upside exhaustion signal happened, and it happened in 2006, and we went sideways for a year and a half before it was wrong. So it did indicate upside exhaustion at the time. It happened in the next time it showed up was early first quarter of 2008. And that, of course, saw gold go from $1,000 to $700, so a 30% decline. And it took a few years for that to finally get taken out. So what this says to me is we're long gold lower, and we're holding our gold, but this is telling me that we're probably into an area where the risk of first putting on gold longs is much higher now. And that's really what this model is set up to do. It's not to tell you where to go short. It's to tell you when playing in the direction of the trend comes with far more increased risk. Now, based upon the current height of July's, this monthly bar for July, the stop out for this level is all the way up at 2183. If between now and July 31st, we make a higher high in gold, then that number is even going to be higher, which means gold could certainly move higher towards almost that 2200 level from where it is now near 1950. All I'm saying is if you first wait to buy gold now, it comes with a lot more risk. So that's important to kind of understand in the scheme of things. Let's also take a look at a weekly chart of gold miners. So in the no trader clients know we got long this on the breakout of the 7-year bottoming pattern. We are still long, and you can see that targets for this include 47.5 or so, the TDST line back from 2013, as well as if I take a look at this year's low to the first high and measure that and add that same distance to the reaction low, which also tested the breakout, that says 52.63 or so. So anywhere from the mid to upper, well, the upper 40s to the low 50s is where we've got some resistance and where I'll probably be taking some of this off. And let's take a look at silver also. So silver broke through any remaining downtrend lines it had within the last, this is a weekly chart. So in the last month or so, we broke out, we were long, we got long this for in the no trader clients just before the breakout. You can see why we're stalling where we are. Today, silver has already had a $2 range, which is absolutely huge for this metal. You can see that this high here, which is the green line back from 2013, and the triple bottom from 2011, 2012, this kind of magenta colored line is exactly where we've come to and faded from. So this is some real resistance here. We can do Fibonacci stuff along the way, but just looking at this, simple bar charts, you can tell that why we're stalling in here. Now, I kind of look at silver as poor man's gold. Silver had a 7-year bottoming pattern also that broke out to the upside, just like gold did. So even if silver pulls back, and at some point it certainly could, I'd still be a buyer in this and think that, you know, silver's not done here at this week's high, but it could be temporarily. And that's my view there. And I think that's good for that. So now let's get on to, we've got 8 minutes left or so. Let's take a look at these metal stocks that we talked about. So we're going to start with Newmont Mining, the kind of the big baby of them all. And well, maybe baby's the wrong word. Let's say the biggest of them all. This is a weekly chart. This is a 200-week moving average here. So over the last few years, you can see that this rounding bottom. Now we've shot up. This 13 in here was right before a decent decline. This 13 was on the high. We've got another one now, so again, suggesting that getting long now implies high risk. It doesn't mean you can't make money. And look, you can look back to 2011. So this does have resistance just north of $70. Let's take a look if in 08. Okay, so you have to go back to 1987 to get the all-time high here, which is north of $80. And maybe Newmont does it, but at current price, just beneath 70, what I'm telling you is to first buy it now implies, you know, a decent amount of risk. So if you want to get long this name, I'd at minimum wait for a few dollars to even pull back to 60 if it comes before going after it, if you're going to play for a test of all-time highs. Let's look at Barrick, ticker GOLD. And you can see Barrick has a very similar look, except it doesn't have a 13 upside exhaustion signal now, which if I was going to choose between Barrick or Newmont, I would go for Barrick because it doesn't have the upside exhaustion here. Here's your all-time highs. Well, I'm not going to look. Let's see, 87. No. So those are your all-time highs back up here, just north of 55. So you're only a little more than halfway. This has room to go. I'd still be a buyer on pullback. So when you look at, you know, this whole bottoming pattern too, I think gold names have room to go, but realize there are going to be resistance points along the way. So you've got to, if you're not in these names already, realize that you're going to take some risk if you buy them here instead of buying something, you know, greatly reduced as they've been in the past. Wheaton Precious Metals, WPM. Here we go. Takes out the 2011 high. So this is stronger than any of the other two we've looked at before. And at this point, it says support somewhere around 53.5 or so in that neighborhood. It's now 56.41. It targets all the way up to 68.75 or so. So there's plenty of room here for this thing to run on a parabolic type move. Anything close to that level here, near that 68, 69 level, anything even remotely close to it, I'm going to take off exposure. Agnico Eagle, AEM. So here's the 2010 looks like the high. This is already hitting some targets here. Again, good rounding bottom, the fake out in March that took everybody out of longs before it zipped back up. So here, if I look at this, I'm going to take the low from this year, go to the first major high, take that same distance off of the reaction low, and you can see it targets essentially the full propulsion level at $94. That would be your bigger target over time, which does take out the all-time highs. At this point, look for some support in the upper 60s to near 70. Anglo Gold, AU, the ticker symbol. Similar look here, rounding bottom. This has already reached past any of its near-term targets. Let me see if, here we go. Next upside target I would put is about 45.5 or so. I'd say support 27 through about 30 or so on a pullback. Silver stock, Pan American Silver, PAAS. So you can see how this has moved dramatically off of the March low, and especially even in the last month or so. This thing has just rocked from, looks like, what is that, 25 up to almost 39. Long term, bottom here, bottom here, bottom here, major support. You're going to come back towards the upper end of the range, and we're doing that now. So I don't even have an exact target price other than looking at somewhere around 42.5 or so against these old highs. And you can look at this kind of two ways. I do this with both a trend line, which we're getting very close to, as well as the actual horizontal levels. So this zone here between 40 and about 44 or so is where you could certainly lighten up and then look for this to get a pullback before it potentially goes higher. Let's take a look at Kinross, KJC. So Kinross is a much weaker name. It's not anything close to the highs, but it is breaking out. The only thing here that I see of some problem is the 13 signal, again, suggesting upside exhaustion. So if I'm long these names, I can stay long. I just don't want to be adding right here and now. Initial, there's going to be 930-ish or so is going to be some resistance. And if I do the same type measurement higher, what I call equal legs. So if we take the low to this high and add that distance to the low, measures to 1086 or so. So I might take small piece off at 930 and more so at 1086. Harmony, HMY. So huge move up. They're all going to have this huge move up. It's all about relative to where they've been before. So if we can find other resistance levels. First resistance level now that I see is 847. It'll have other ones on top. And let's just take a look here at a wave count. This is only in wave 3. So at some point, you'll get the pullback, which will be wave 4 before it makes its final thrust. So this, I think, the fact that you're through the 2016 high and you have this whole rounded bottom, this looks like it also, there should be a lot of built up demand for this name now. And all the shorts who have poo-pooed on the metal sector for a long time are gonna pay the pipe. Alamos Gold, this is one I actually own myself from about $5. I bought this 9 in here for myself, and now let's see. So it's on a 12. I may lighten up next week as this moves higher. So I also know that this, I actually think, if you take a look, and this is how we'll finish up with this name, kind of looking here. So I wouldn't expect it to get much lower than $10 or so on a pullback. And I still like this name over time. Hopefully that helped a lot. I'm Rick Bensignor. Thanks for listening to this week's In the No Trader Show.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.